welcome to the Capital Market. I am Bosin Amafaye, and we're glad to have you on the show this evening. Let's get it started. What's making headlines in the market week we just put in behind us? PZ Cussons, Chapel Hill Denham, an investment bank and securities trading firm, issued an equity research report saying the company's full year 2020 earnings revenue will decline 4.3% year-on-year to 71.16 billion naira on sustained weakness in home and personal care products of the company, but growth is anticipated in PZ Cussons' durable electrical appliances business unit. Sustained cost pressure is anticipated by this company, according to the equity research report, as continued marketing spend will likely see the company's earnings before interest, taxes, depreciation, and amortization merging down to 2.1%, leading to a loss after tax of 1.09 billion naira expected in the year. Chapel Hill Denham therefore downgrade PZ Cussons' rating to sell from hold and lowered the company's target price to 4 naira 39 kobo from 7 naira 19 kobo previous. The expected total return of PZ Cussons PLC for the year 2020 is around negative 15.9%. In the week, May and Baker informed the market that it's secured a contract manufacturing agreement with Sanofi Nigeria, a subsidiary of French pharmaceutical giant Sanofi. M&B will use its WHO certification to make 4 types of drugs to be sold in Nigeria and across West Africa, which include Flagyl tablets and suspension, Tarifit tablets, as well as anti-infective medicines and another malaria drug by the name Malarage. In the insurance subsector, the deadline for June 2020 is still apace, and there have been a number of changes at the leadership position, or some of them. Now, Mutual Benefits Assurance PLC, a group of company, announced the appointment of Femi Ashenuga as the new managing director. He is the one replacing Olusegun Omoshehin, who is retiring from Mutual Benefits Assurance from next week, Monday, December the 23rd. Also during the week, Nigeria's only E&P, Seplat Petroleum Development Company, completed $350 million cash purchase of the total shares of Eland Oil and Gas PLC of Ireland, and trading in the shares of Eland PLC ceases on the London Stock Exchange and are added to the shares of Seplat Petroleum. Back here at home, Chapel Hill Denham issued an equity research report also during the week on Dangote Cement, the largest company on the Nigerian Stock Exchange by market cap, cutting Dangote Cement's full year 2019 earnings or estimate group revenue forecast by 1.9% to 896.2 billion naira. The company's EBITDA was also trimmed to 43.9%, but the company will likely benefit from lower yield curve in the market and the tax allowance to buoy its earnings for the year under review. Meantime, Chapel Hill retained buy rating on the shares of Dangote Cement. Now let's talk about the debt market in 2019. I had a very incisive and extensive conversation with the Managing Director and Chief Executive Officer of Afrinvest Securities, Ayodeji Ebro, on Friday. And this was part of what he said about where we were in the year outgoing and what you need to think about as we get into the new year when you look at the fixed income, basically the Naira bonds and the Treasury bills market.
We've seen that the trend as a result of the policy, the CBN, based on his own policy, discovered that a lot of even the local investors, even the banks, were just sitting and borrowing and putting funds in the fixed income market, enjoying that high yield.
Lending money to the government and just sitting back and see their money work for them as it were.
Yield,
but yeah. I want to put this a chart on the screen for our viewers to see, which is the fixed income market. That's what you folks call it so far this year. And this yield curve looks like, that's what is on the screen right now. Ayodeji, I'm sure you're looking at that. It looks a little bit like putting a spaghetti in hot water.
Yes, yes. So, yeah, starting from a high of close to 15%, even if you look at the first primary market auction for this year, in January, the first primary market auction, yield was around 14.5%. That's in terms of discount rates. And the last one that held just on Wednesday, the discount rate was around 5.9%. You can see that massive drop. We've seen that with the policies, when you let's review, looking at some of those policies that led to this.
That's why I want the chart back on the screen.
Those policies
quickly to explain, because if you look at where we're coming from, as at the end of December last year, about the same time last year, and that is the green line there. That's what we're trying to explain, the downward trend in the yields despite the election. So we had the elections, yes, but you think that was not a major disincentive?
Yes, CBN was very deliberate in terms of trying to see how investors, banks can begin to look at other investment options. When you look at after-tax yield was as high as 16%. As a result of that, the first major policy that we saw, one of the HOMO auctions, that CBN excluded the banks from participating in that HOMO auction. Weeks after that, we saw the circular around for borrowing clients, for clients that have borrowed from the bank, should not also be given access to treasury bills and HOMO auction. Some weeks after that, we saw that total exclusion of individuals, corporates, which also involves the PFAs, from participating in HOMO auction. And when you look at the dynamics or the structure of the fixed income market, HOMO bills account for close to 70%, with about 14 trillion naira in terms of HOMO bills. Out of that 14 trillion naira, 42% of that, which is held by foreign investors, about 32% held by the banks, and the remaining 25% being held by PFAs and fund managers. So when you quantify that amount, about 3 trillion naira, it means that as you have maturities, those funds, a major part of those funds are unable to be reinvested into the standard HOMO auction that we normally have. And based on the dynamics of demand and supply, there's been a shift in the demand. So the PFAs, which are the major investor within that space, have moved to the Nigerian Treasury bills, which is being issued by the DMO through the CBN. So as a result of that, yes, the yield has dipped significantly.
So, yes, that's just putting that chart
into perspective.
To perspective, because if you look at where we're coming through from about 16% at this time last year, then we went down just around the election period. Then it looks like we're going to have a bit of an uptick. But again, that didn't happen. Of course, that's where the middle of the screen is. Then we have that major dip from June, right? Around June. Then there was that beep there, and it's all the way down till where we are at the moment. So this is a bit of the chart there, but let's talk about the primary market, which is, of course, where the central bank and the debt management office, and at the back end, the Ministry of Finance, by the way, the federal government, is actually teleguiding where they want the yield curve to go. What's the mindset of the government here in terms of what goes on into the primary auction calendars for both the central bank and the DMO? Yes,
interestingly, last year, based on the calendar that the DMO released, they planned only to roll over maturing bills. That means that, because typically what you have before is that you see, in terms of the DMO, raising additional funds apart from the maturities. If you look at the total sales in terms of NT bill, Nigerian Treasury bills this year, it's about 2.8 trillion, which is lower than what was sold, about 3.3 trillion naira last year. And you look at the HOMO auction this year so far is about 14 trillion, close to 15 trillion this year, which is also lower compared to about 16 trillion naira worth of HOMO auction that we saw last year. So we've seen that even for the government, they've tried to taper down in terms of the borrowings that they want to, especially short-term borrowings. It's bonds that we've seen significant jump, over 200% this year, to about 576 billion in terms of long-term borrowings.
That's what the debt
management office.
With the new 30-year bond, Naira bond.
Yes, there was a new 30-year.
Yes, the new 2049. 2049, the longest we have in the market. So if you look at that, therefore, the government is borrowing, but try to rejig. So was that what was announced in 2017? Is this part of the playbook of what was announced late in 2017 that the government want to restructure these domestic borrowings.
Yes,
is that what we're seeing play out right now?
In terms of the amount that is being offered, that's what we're seeing playing out. But in terms of the current yield environment,
yes,
this is like a deliberate policy from the CBN, trying to see how investors, as well as the banks, can begin to channel funds into the real sector. Though the real sector still has its perceived inherent risk, but rather than put your funds in a risk-free investment, in quotes, and earn 16%. When you look at, in terms of the margin on most businesses in Nigeria, where you look at, for most of them, maybe between 15-20% because of the high cost of doing business in Nigeria. So what would typically happen, so starting from when the CBN tried to persuade in terms of the policy on loan-to-deposit ratio in July, and moved that to about 60% and September to 65%, and we're expecting that there's an announcement that it may likely go as high as 70%. So now...
Does that include the policy also on using what you call the cash reserve ratio, which the central bank also announced, Godwin Emefiele announced, and says, well, this is an encouragement. If you lend to manufacturing, industrial, whatever, your CRR sitting with us will be used. You think all of this coupled together since June gives us a different scenario that we see if you put the table, if you put the chart back on screen to look at the different offerings that has been done and how the monetary policy have been trying to tweak, get not just the size of borrowings, but also the yield curve, as you said, trying to get push credit to the banks into the private sector.
Yes, the major target, which the CBN has made very clear, is they want the banks to channel more funds to the real sector as much as possible. Yes, we're all aware that in terms of the risk is really very high, but what we're also seeing now is more of repackaging existing loans. Yes, we can say loans, when you look at in terms of the statistics, lending has increased, but what is refinancing? The game out there now is banks are buying off existing loans at lower rates from other banks. And for any rational investor, they will be willing to go with the bank offering the lower rates. So we've not really seen in terms of creating new loans, new portfolios that will really impact as much as possible the real sector. And if we don't see that, what would only see it's more of repackaging. So for the complaints, yes, for them, the cost of funds or their finance cost would go down as much as possible. And that would help them in terms of the margin for existing companies. So but we also need to focus on the informal sector.
So technically, the banks are deleveraging amongst themselves.
Yes, that's
creating the markets. So that goes to the latest report we have in terms of non-performing loans and all of that.
Yes, that's in terms of non-performing loan, you would expect if the base has increased, and you don't expect that those loans that just this policy started in July, and you don't expect that those loans will become non-performing immediately. So it's not a surprise that in terms of the ratio of non-performing loan has gone down. The loan, which is the base, has increased, and the non-performing loan, we don't expect that to crystallize immediately before we can begin to know how effective this has been, and in terms of to rightly capture the non-performing loan. We need to also give some more time to see that for those, if there are new portfolios or loan portfolios that have been created, how have they been able to pay back after a certain period? It's based on that we can begin to gauge how effective in terms of the risk management policy of most of these banks.
Because I see in the newspapers almost on a daily basis, and some of the activities of some of the, let me use the word, the big banks, commercial banks, are beginning to show that they're putting out advertorials that appeal to folks in the creative sector, to those who are in fashion, in entertainment. They're asking them to step forward for loans, those who are in agriculture, agro-allied. So it begins to look like the banks are wooing those who are in the real sector And if you look at the GDP numbers printing in some of these sectors like music, entertainment, and what have you, it looks like the numbers are beginning to gradually on the rise, and the manufacturing and industrial output going by the Q3 GDP numbers. So do you see that this monetary policy approach, what you call the unorthodox central bank policy, is beginning to knock at the door of the real sector, even though the door is not yet fully open, and there's an avalanche of loans going into the real sector? Is this yield curve environment, therefore, encouraging to the folks, the SMEs, the one-man business who are out there? Should they look at the current yield curve at the debt markets as an indicator of them to come out of their shells and say, look, we can approach the system? The MPR is still at 13.5, but we can approach the banks.
Yes, interestingly, the focus has changed, especially for the banks. There's been more attention to lending based on the current yield environment. Even for the investors, there's been more focus to what kind of structure can we come up with.
Ayodeji Ebo, the Managing Director and CEO at Afrinvest Securities, a bit of a recap of 2019 debt market and the new yield curve environment. When we come back, we'll take a look at what should be part of your thinking for New Year when it comes to the tax industry. And of course, there's a new member into the body of the city gentlemen we'll unveil after the break. The Nigerian tax environment is not just about the stick with the government looking for more revenue, but a bit of carrots there attached to it. And that was the bulk of my conversation during the week with Yomi Olugbenro, who is the partner and West Africa tax leader at Deloitte, Nigeria. Part of the icing on the cake is for businesses in 2020, what they call deferred tax and tax relating to dividend payments. If you have companies listed on the stock market or any other securities market in Nigeria, you may need to listen to how the new tax environment, including the new finance bill, may improve your wealth in 2020. Take a listen.
Everybody to be tax registered. We're also looking at the impact of the VAT. A number of people have projected that with the rise from 5 to 7.5%, there's a possibility that that will spark up inflation a little to 11 or above 11% or thereabouts. So the economists are doing all of the calculation. But I don't know whether the impact of the fact that micro and small businesses will no longer have to charge VAT on their transactions have been factored in. Because if you actually remove the transactions in the informal sector and the small players who will no longer have to put the tax bill, on their invoices, that should also compensate a little in terms of the what the inflation will be. So we're watching for how that will play out. For the large corporate, I think it will be a particularly interesting year because of some of the incentives coming from the finance bill. The excess dividend tax, minimum tax, even infrastructure tax credits, that the government is, putting on the table for people to finance capital spending, and infrastructure development. I think all of that will be a major boost to the bottom line of large corporates.
For large corporates, the issue around dividend tax is quite interesting.
Very interesting, because it's been one pain point that's been, affecting dividend policy. So you're mindful of extra check you need to cut out for the taxman if you pay beyond certain amount in dividends. But now that the rule has been refined and the pain point has actually been lessened, chances are that investors and large corporates will be able to smile better in 2020 because they now have greater capability to leverage retained earnings and all of their income to pay higher dividend.
So that's about tax for next year. But let's wrap up part of the stories on the market this week is that the Managing Director and Chief Executive Officer of the Central Securities Clearance System, Haruna Jallow Waziri, has been inducted into the Chartered Institute of Stockbrokers. Jallow Waziri was an executive director in charge of the capital market at the Nigerian Stock Exchange until he was appointed the head of the CSCS a few years ago. Jallow now joined the list of distinguished personalities at the Institute, which includes Oscar Onyema, the CEO of the Nigerian Stock Exchange and the Acting Director General of the Securities and Exchange Commission. Haruna Jallow Waziri previously served as former Managing Director of UBA Stockbrokers Limited and UBA Asset Management. But how important was Jallow Waziri's admission into this professional body of stockbrokers whose practice goes by the motto, "Our word is our bond"? Dapo Adekoje is the president and chairman of the council of the institute. Take a listen.
You will recall that just 2 months ago, the Chartered Institute of Stockbrokers held our 23rd annual Stockbrokers Conference, where a whopping 232 distinguished professionals from various sectors of the Nigerian economy who had passed the world-acclaimed professional examinations of the Institute. They were all admitted as full members, as associates of the Institute. This evening, I therefore have the pleasure of welcoming my very good friend, who has been very long in the market, who humbly sat for the exam too, not minding his position. I'm happy to welcome you to join the gentleman's profession and the privilege of using the affiliates of ACS of the Chartered Institute of Stockbrokers. For those of us here present who are not familiar with the Institute, assistantship connotes full membership of the Chartered Institute of Stockbrokers. Like I said earlier, after this induction, Mr. Jallow Waziri is fit and highly privileged to use the prize letters ACS after his name. The Chartered Institute of Stockbrokers is the body statutorily empowered to train and certify the core professionals in the Nigerian capital market. It might interest you to know that the Chartered Institute of Stockbrokers has relationship and in partnership with CC UK and ASEA of Europe. Once again, I congratulate you, Jallow, for this, your induction as an associate of this noble institute. It is a landmark event in conferring unto you a higher level of honor and intellectual accomplishment. It is a mark of character, capacity, and competence. I urge you to maintain the good name and reputation of the Chartered Institute of Stockbrokers and continue to contribute positively to the growth of our great institute, the securities and investment profession, and the Nigerian economy at large. Ladies and gentlemen, I welcome you to this historic event as you witness the induction of Alhaji Jallow Waziri. Thank you very much.
The Nigerian market will be on a two-day holiday next week. Don't forget that Wednesday and Thursday. So we'll have the market down by 2 days. So expect a lot of interesting trading action as we wrap up for Christmas. Have a good evening, everyone, and goodbye from Lagos. I'll see you next time.